Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, the Q3 earnings season is shaping up to be better than originally anticipated in many analysts' minds. We'll see if our research director, Shiraz Mian, is one of those people. So in the aggregate, since the last time we spoke, have companies been reporting earnings much above estimates?
Yes, I think you could say that. In fact, when we got underway, Terry, not only the proportion of companies beating estimates, but also the magnitudes of those beats were really off the charts. They have come down considerably as we have moved towards this later stage of the reporting cycle, but on the whole, that's a correct statement.
All right, then let's run down the scorecard here. Let's talk about growth, revenue, sales, the whole ball of wax.
The whole thing. So we have 447 of the S&P 500 members have reported, as we show over here. Earnings are down 1.7%. Revenues are up 4.3%. 72.5% are beating EPS estimates. 57.9% are beating revenue estimates. We will have those numbers in a context, and I have a chart for that, Terry. But on the whole, earnings are down, revenues are up, meaning margins are squeezed, and that's what this second bullet point is showing. And 8 of the 16 sectors have lower margins than the year earlier period. So let me put the growth rate for these 447 in a context, and we are comparing the same 447 companies across time. The left-hand side chart is comparing earnings growth. The right-hand side chart is comparing revenue growth. And as you could see, the earnings growth, it's been quite anemic this year. The first 3 quarters of this year, including Q3, there's not much growth. But the revenue picture is fairly decent, 4.5% growth. And here's the proportion of positive beats that you were asking about. So 72.5% are beating EPS estimates. It's a shade below the 12-quarter average, which is close to 75%, but within that historical range. 57.9% are beating revenue estimates. The 12-quarter average is about 65.9%, so a little on the lower side of that range, but still within that range.
All right, so talk to us a little bit then about sectors that reported year-over-year gains, those that reported year-over-year declines.
Sure.
And when the dust all settles, what the bottom line for Q3 is going to show.
Sure. So I have this table. It's a busy-looking table, Terry. But here we are showing the blended picture for the quarter. And what we mean by that is we showed earlier the 447 that have reported. The other 53 that are still to come, we combine both of them. And at the bottom, it shows a 2% earnings decline, 4.3% revenue growth, and 80 basis points in contraction in margins. The 3 rows that I have underlined, these are the sectors with the biggest year-over-year decline. So energy, almost a third lower earnings in Q3 compared to the same period last year. Basic materials, 28.5% decline. I have underlined technology too, even though its decline is small, 8% year-over-year decline, but technology is a much bigger piece of the market as a whole compared to energy and basic materials. So I wanted folks to know. On the positive side, towards the bottom of that table, we have business services, 16% year-over-year growth. Utilities, 10% year-over-year growth. So not a whole lot of the major sectors that you expect to be driving growth are giving us the growth. Technologies on the negative side, finance modestly on the positive side. On the whole, when you have a 2% decline in the aggregate, then you know that all of your major sectors are not producing growth.
So, excuse my pessimism, but I always have to interject a little bit of it. 4% revenue growth seems a little anemic to me, is it?
Well, it is anemic. But if you have a 2% decline in earnings, you have a real negative number in front of earnings, and you have a positive number in front of revenues. So 4% is not a whole lot of growth.
Right.
But in a global economy that's slowing down, in a U.S. economy that's growing at less than 2%, there is still a very strong showing from these companies, particularly when we know that last year in 2018, we had all-time record quarterly earnings. So it doesn't look that impressive. The growth numbers don't look that impressive. But relative to where we have come from, the fact that companies can maintain that high level of profitability is impressive.
All right. One thing that is high right now are stock valuations, and some are at all-time highs. Have we seen anything in this reporting season, though, that justifies those high stock valuations?
So I have a chart that I'll share in a little bit, but my narrative and thesis on the earnings front all along has been, Terry, that the market wrote off growth in 2019 and pinned all of its collective hopes on growth resuming in 2020 and beyond. And relative to those expectations for 2020, the reassuring part about this earnings season was that relative to those fears that these companies will come out and overwhelmingly guide lower for Q4 and also for full year 2020, those fears have not been realized. So we are still in a wait and see mode. There's still positive growth expected next year and beyond. And as long as those expectations hold up, market bulls can get that reassuring impetus from the earnings side that yes, the multiples may be very high, stock prices may be all-time record levels, but if the corporate profitability moves in lockstep with that, coupled with still very supportive interest rates, then we should be in good shape.
So another earnings decline for Q4?
Yes. I have the slide where we are showing the highlighted portion is Q3. I didn't know you were going to ask about Q4. But in here, you could see it's a 3.2% decline in earnings for the S&P 500, and that would follow obviously the 2% decline that we are on track to be getting for Q3. So yes, another decline, at least currently, is expected in the last quarter of the year as well.
So things begin to look brighter than in Q1 of 2020.
That's correct, and you could see that in this chart. So the last bars here represent the first quarter of 2020. There's 4.9% earnings growth and an equal amount revenue growth in the first quarter of 2020. And then the expectation is that that growth momentum accelerates towards the middle and back half of the year. So the outlook for 2020 is a lot more positive on the growth front than what we have seen in 2019.
And are those earnings forecasts for 2020 too high?
So that's the million-dollar question. And I have this slide that I quickly want to share with folks here. In here, the highlighted portion is the 2019 estimates. 2019, 1.4% earnings decline. And then next year, 8.5% earnings growth. And then the following year, 2021. Remember, 2021 is expected to come too, Terry.
It is.
Don't forget about that. A 10% earnings growth is expected in that year, as long as these expectations hold up. Now, some of this will come down.
Yeah.
But as long as there's positive earnings growth in 2020, I think that should be reassuring enough for the market to sustain its momentum and continue moving higher.
10% in 2021. That sounds a
2020.
little rosy to me.
Well, there's a full 2020
Yes.
between now and 2021, so
Yes.
we'll see.
All right.
Yeah.
Well, we thank you for that, and
Sure.
we're wrapping up now the earnings season for Q3 pretty
Absolutely.
much, right?
Absolutely.
So we just
Yeah.
have retailers,
That's right.
and it'll be interesting to see going into the holiday season.
Absolutely. We have, in fact, this week, Walmart comes out and reports results. So Walmart will set the stage up for what to expect from retail earnings.
Yeah.
Yeah.
All right. Always interesting talking with
Sure.
you. Don't forget, if you want to read Shiraz's written commentaries, just go to Zacks.com's homepage, and you can generally link to them right from there. Earnings preview on Monday tells you what to expect in the coming week, and earnings trends, earnings outlook on Thursday kind of recaps what's been going on with the reporting season, any changes in the nuances, et cetera, et cetera. And also don't forget that for a limited time, you are invited to follow Zacks Market Insights, buys and sells from all of our recommendation portfolios. And you can do that in real time, and it only costs you $1. Now, the offer is not going to be there forever, so you might want to look into it if you are so inclined. You can even look into services here at Zacks that typically have been exclusive for members only. All you need to do is visit Zacks.com/promo for details on how you can do that. With Shiraz, I'm Terry Ruffalo.